$2,200 gone just like that on one trade. Let's talk about it. What's up, ladies and gentlemen? This is Eddie Harvey from TradeWithEd.com. All right, guys, today we're going to be talking about Forex Risk Management. And I want to get into, guys, a trade that I took, and it was nothing good about it. So I'm going to share with you exactly what happened and how you can prevent the same thing happening to you. But before we do, guys, listen, if you find this video to be of value, do me a huge favor and hit that like button. And also, if you want to see more of my content, go ahead and subscribe to my channel, and also hit that bell to be notified when I drop new content. So let's get into it. All right, guys, listen, Forex, when it comes to that, your risk management is everything, guys. Risk management, breaking it down, it comes down to what are you willing to risk in the markets, and also what you want your reward to be. So if you're going into a trade, you're looking at risk reward ratio. You've probably heard this term before, and some people talking about a 1-to-1, a 1-to-2, a 1-to-3, things like that, right? So when you look at risk management, a 1-to-1, that means, let's say you're willing to risk $10 to make $10. Now, some people say, that's not good. Some people say, hey, I'm good with that. If you have a solid, sound strategy, winning at a good clip, you'll be okay with a 1-to-1, right? When you talk about a 1-to-2, you're talking about risking $10 to make $20. A 1-to-3, you're willing to risk $10 to make $30. Obviously, the higher the risk reward, right, you're going to make more, but it's also going to require you to be in the market a little longer. Okay, so many different things play into where you want to get in and get out at. Comes down to your trading style and what's comfortable for you. So that's one part of risk reward, and managing your risk is knowing what you're willing to risk in order to get what you want to make. Because if you look at a trade where you let's say you lose one trade and you're doing a 1-to-1, it's going to take 2 trades to get back what you lost and make profit on top of that. So that's why some people say starting with a 1-to-2, it kind of mitigates that, right? Knocks that out, because now if you lose one trade, now on a 1-to-2, you lose one trade of $10. It's going to take you one trade of $20 to get what you lost and then make up for that. So again, it comes down to a comfort level, and obviously all of it makes sense. You don't want to do anything less than 1-to-1. But moving on from that, that's the one thing you want to look at. Also, guys, in addition to that, the one thing I want to talk about as far as determining a risk is using proper lot sizes, guys. A good rule of thumb when it comes to lots is a 0.01 lot for every $100. Now, let's say if you have a $1,000 account and you're trading, right, you can go to a 0.10 lot, which is called not a mini, but a micro lot, where you're trading $1 per pip. Okay, so if you look at $1 per pip and you're saying, hey, well, I want to risk 2% in order to make 6%. So you're going to be willing to risk. You're going to do, so if you have a 0.10 lot, you're willing to risk 20 pips, right? Which is going to be equivalent to $20 in order to make 60 pips, which is going to be equivalent to $60. It's a 1-to-3 risk to reward. So hopefully those things make sense. So what I want to do now, guys, get into and switch gears a little bit and share with you how I took this L on this trade, guys, and how you can avoid the same thing happening to you. And I hope you get some value from it. Let's take a look. All right, guys, so here we are on this trade. Let's look at this trade that I took, and let's see where I went wrong with it. Okay, we're going back, guys. And now this trade that I took, this was actually over a year ago, almost a year and a half ago, right? It was March 31st. Here we are right here, March 31st of 2021. So even at this point in time, guys, I shouldn't have been trading the way I was trading. I screwed up on this trade, and it was wrong from the start. And I got caught slipping, and I took a nice loss on this. So let's talk about what went wrong for me. So obviously we're here talking about risk management, right? I wasn't using proper risk management. That's number one. Right out the gate, I wasn't using proper risk management. I didn't have a stop loss nor a take profit set. Okay, so I was literally watching a trade, right, thinking I'm about to get in and out based off of what I saw, and I'm explaining to you what I saw or what I thought I saw and why it didn't pan out that way. So that was the first thing, the first error that I made. Okay, number two, on this trade, guys, on this trade, the next thing that I did is that I wasn't continuing on risk management. I was over leveraged, and I was using a higher lot size than I should have been using on this trade. Okay, now my account was able to handle it, but definitely, like I talked about earlier, a good rule of thumb when it comes to trading is a 0.01 lot for every $100. Now, let's look at what I was trading as well. I was trading the S&P 500, also called SPX 500 or US 500, right? This is an indice, not a Forex pair. Trade is just like Forex, right? But you're going with a higher risk reward. Okay, rule of thumb, if you are trading indices, you should not be trading indices with no less than $1,000 1,000 US dollars in your trading account. Okay, why? Because indices moves at a faster pace, and the the uh, the payout ratio, the PIP ratio is higher in indices 10 times over Forex, right? So with Forex, a 0.01 lot is equivalent to 10 cents, right? Now over here with indices, depending on what broker you're using, a 0.01 lot is equivalent to $10. Now, is equivalent to $1. Now, why is that? Part of it is because you're looking at where 1 pip in Forex is equivalent to 10 pips or 1 point, as it's called, with indices. Okay, so now you're talking about if you're on a standard $1,000 account for Forex, you would do a 0.1, right, which would be equivalent to $1 per pip. Well, a 0.1 with indices is equivalent to $10 per pip. All right, so wanted to just share some of that. Hope some of the screenshots help make it clear up some things for you on that as well. So looking at this, let's get into it. The third thing I did, guys, is that I was not trading using my trading strategy. I didn't stay true to what I normally do, what I normally see, and my rules of trading that I follow. And that resulted in me taking a loss that I took. So here we are. Let's look at it really quickly, right? Coming over here, this was just so all wrong. So we had consolidation right here, right? What I should have waited for, I like to trade the break and retest strategy. And I did not do that because based on this, right, I entered this on a sale and that sale did not pan out. So based on this, what I was looking for, if you look at what I have right here, this is my level of, right, this is a level of resistance right here, right, level of support here, okay? So now seeing that, what I should have waited for on this trade based off of, obviously one of my primary confirmation, I should have waited for the price to, out of this, somewhere in here, come down, break, retest, then go for a sale. But I didn't do that. That was not the case, okay? What I actually did, if you look right here, move this out of the way. If you look right here, I got in literally right here. Okay, so what I was looking at this to potentially reverse. I saw price went up. We had one candle close right here, a bearish candle. Then we had this nice strong engulfing candle right here, right? And I entered right in here. Okay, this is where my entry was at. This is where my entry was at, like literally 39.81, right? So I got in right there. So just to show you guys, here, let me blow this up a little bit. But look what it did. It just literally, all I was going for was 10 pips. So all I was going for was 10 pips on this trade. So if I was just going for a total of 10 pips, 39.81, $39.71. It literally was a few pips away from my TP, right? It was a few pips away from my TP. It went down about 7 pips, and then look what it did. After that, it literally reversed. It really didn't reverse. It just had a small pullback and then continued in the direction it was going. Because if you look at the overall trend here, right, it's bullish. So that's what I was trying. I got myself caught in a bull trap per se. I mean, a bear trap per se, right? Where I thought it was going to reverse and I thought it was going to come down here. I was trying to get a quick hit because 10 points is equivalent to 100 pips, right? And that would have been a nice profit for me. Was trying to come down here, and instead It bounced off, played in this area, and I clearly wasn't watching it, right? And then it took off on me. So when I look back on it, I was trading 0.13, was equivalent to $13 per pip. Trade took off in the wrong, well, in the right direction, but wrong direction for me. And literally, I got in right here, right? What's the 39.1? Now, right there, boom, 169 pips. That's where I got out of this trade at. I would think it was a margin call for me right there. Or I think I closed it out manually, if I remember right. And I was like, all right, that's it. But then right after that, look what it did. It did drop, it pulled back, and then it continued up. You see, this is why you use a stop loss, guys. So for me, I was going in trying to win $100+ ended up losing $2,200 on one trade, guys. That's why using stop loss is important, mitigating your risk, trading with a proper stop loss and a proper having to take profit is important. Because had I came in here and literally just had set even a 5 pip or a 10 pip stop loss, right, on this trade, now you're looking at, I would have literally only lost $50 to $100 on this trade versus $2,200 I lost. So just wanted to share that with you guys. And if you look at this, this was everything I shared with you. I did everything wrong on this trade. It was a trade. I don't know what I was thinking at the time, but this is why you go document and look at it. And this is why I remember this trade and I was able to come share this information with you guys. I don't want to see none of you in this situation, right? But you live to trade another day. You bounce back, you learn your lesson, you take notes and say, look at what I did wrong. And I just literally showed you guys everything I did wrong. 4 things to recap, right? I was over leveraged, right? I didn't use a stop loss and a take profit, right? I didn't follow my proper trading parameters, and I was trading against the trend. 4 things where it was 4 reasons why I shouldn't have gotten this trade, but I did anyway. But wanted to share with you guys, and I would tell you guys this: if you're gonna trade, guys, always and forever trade using a stop loss and a take profit. I don't enter a trade without one. I don't care what it is. I'm using proper risk, right? I know the risk I'm going for in my trade. I'm using a stop loss, take profit, guys, and then follow my trading parameters and trading with the trend. Unless I'm trading a reversal, we're in key zones. When those things happen, guys, good things will happen for you, okay? And you will be in this trading game a long time. So I hope you guys did get some value from this video, guys. And listen, if you want to learn more about Forex trading, how you can learn this skill set, get education, mentorship, tools, and resources to help you earn in the market as well, simply go to tradewithed.com. And if you want to see more trading videos, guys, definitely look at my recommended videos that's coming up here in a second for you. Once again, I thank you for your time. And if you found this video to be of value, do me a huge favor and definitely hit that like button. And if you want to see more of my content, guys, be sure to subscribe to my channel and also hit that notification to be notified when I drop new videos. I will talk to you guys soon. Take care.